Hi, everyone. My name is Phil Matee. I'm the Director of Marketing for the Feliciano School of Business. You're joining us today on the Business Edge podcast, as well as a video that's going to be on our social media. I am here with Dr. Luis San Vicente Portes, who is a professor of economics at the Feliciano School of Business. So thank you for joining us, Luis. How are you?
Good morning, Phil. Very good, thanks.
So today is March 30th. For those that are listening or watching, we had an interview with Luis back on March the 5th, which seems like a very long time ago, considering what has transpired over the past 30 days. Typically, we do these interviews in our studio in the building. You've probably seen it on our social media channels. Obviously, we're practicing social distance. So I'm in my office in my home, and Luis is doing the same at his home. So we're conducting this via Zoom. And the audio is on the podcast, and the video that you'll see as you're watching now, if you're watching, is via our Zoom video. So we're talking today about the coronavirus impact on the U.S. economy, which is what we spoke to Dr. Portes about a few weeks ago. And obviously, it's had a major impact on the economy. So this interview is a follow-up to that interview. And just to put things in perspective, on March the 5th, on the original interview, there was one case in New Jersey. One only case in New Jersey. There was a handful of cases in Washington, and obviously South Korea and China was really where the coronavirus had cases back then. Fast forward to March 30th to today, in the state of New Jersey, I think the last time I checked, we have over 14,000 cases and spreading rapidly and growing by the day. So in the span of the last 25 days, things have changed dramatically, which led me to invite Dr. Portes to this interview to get his perspective on what has changed and where we're going. So with that said, our first question is, what impact has the virus had on the United States economy as of today?
Yes, thank you. Thank you to have me back, Phil. I remember that morning it was announced the first case here in New Jersey, and so much has happened. Let me start with this. What we discussed at that time were the possible scenarios that would develop, not the things that might take place in terms of the spread of the disease and also the policy responses. And now that we are 3 weeks later, all those things that we discussed have materialized. So there are no longer question marks. We are aware of the spread of the disease, whether it was going to be contained to China or spread globally. Now we have the answer, has spread globally. What would be the tools that would be necessary to address it? As we'll discuss further on today, they have been deployed in terms of monetary, fiscal policy, and health policy. And now we're beginning to see how this region has been one of the worst hit in the nation, and we're heading to be one of the largest as well in the world so far. So as for the question, the impact on the economy, let's reframe it to that conversation. The dilemma that we have in terms of policy is that health policy is the priority, but somewhat countervenes the economic policy, right? When we are told to stay home, then people stop spending. That's a spending shock. When we're told to stay home, companies don't have the same access to their workers. So that's a production shock. And both of these are detrimental to economic activity, but it's understandable that the priority is to get the health risk out of the way and then think how we're going to resume economic activity. Now it's focalized still mostly, well, it's in all states of the country, but to different degrees. So eventually we'll see in the next couple of weeks whether this evens out throughout or some of the policies that we have introduced allow it to remain mostly clustered as it is of now.
Yeah, and yesterday, the president of the United States, President Trump, announced extending the guidelines, the social distancing guidelines through April 30th. At one point, I guess a few days ago, he was hoping that by Easter, it would happen. Obviously, he's listening to his experts there at the task force and extended to April 30th. New York City, as you mentioned, New York is really the one that's hardest hit with respect to the virus. And I think the last time I checked, as of yesterday, New York itself has about 60 or 65% of all cases in the United States alone. Number 2 is New Jersey. And obviously our proximity to New York City is seeing why we're the second largest state that's being impacted simply because of our connection with the city. But what's going to happen? And again, no one has a crystal ball. And I've had conversations with friends, family, colleagues who've said, oh, I think it'll be over by May or June, or I think the guidelines will change. No one really truly knows. It's a big mystery. But what we can look at is South Korea and China. They were shut down about 8 to 10 weeks from what they're sharing with us. So if we look at this 2 weeks ago is really when we started doing social distancing. So it could potentially go until June, and I say June, and that's not for the entire country. That could just be for New York, New Jersey. Again, we don't know. So if what's the issue if this continues to grow, if the cases continue to grow every day, which we expect, and if it goes a little bit longer into the summer, what impact will that have on the U.S. economy long term?
Yeah, that's wonderful to phrase it like that, because so far the cases are mostly clustered, as we mentioned before. I'm hoping that the rest of the country more or less writes it out in a safer way through these lockdown decisions. However, the longer that we take, the experiment that's been currently run in terms of fiscal policy, because the tools that the government has for getting the economy more or less on its tracks are first the ones they deploy with interest rates, to interest rates cuts through surprise meetings, unscheduled meetings. And then the package, the third one that was passed on Friday, each time growing more. This is in $2.2 trillion. And what this package is trying to do is to substitute the real working of the economy through monetary injection by the government, even by giving households checks, by giving loans to businesses, small and medium-sized businesses, that in turn, if they are spent into payroll, into mortgages, into their operating costs, turn into grants. So these loans would be forgiven. So what this package is doing is keeping the economy not really on life support, but substituting the private sector activity through government actions. So in the short run, it can be sustained. Today, I already heard that might be a down payment on what's to come. But again, the government itself doesn't have infinite resources to substitute for a longer time for the functioning of the economy through markets that are part of the private sector.
And it's interesting you bring up the stimulus because of it was passed, I believe, on Friday or Saturday when the president signed it. But one of the comments that have been coming about, or two things I've heard on media, is one, is it enough to sustain the economy over the span of, I think they're saying 3 to 4 months, because the unemployment insurance by the federal government is $600 per week on top of what you're going to receive from your state unemployment. And the comment, or the negative comment I've heard on by different politicians and economists, are saying, are you incentivizing people not to go? It's a person that lost their job last week. Now they're getting essentially 4 months of pay. Are you incentivizing them not to work? Are they just going to sit home and collect and not go back out and find a new job? What do you think?
Yeah, there's confusion in how to interpret it, because the unemployment insurance program is meant to help people out through unemployment spells with a maximum duration of 6 months. And this is a joint partnership between state and federal governments. But what we're doing now is just replacing the role of the firms in supporting workers. This is how it has changed so dramatically. Over the last 12 months, 10 months, the number of unemployment insurance claims were in the order of 200,000 a month, despite that we've been at record low unemployment. But then it rose to 280,000 a couple of weeks ago. And then last week it was 3 million, the seasonally adjusted figure. So this is 10 times larger, more than 10 times larger than usual. And what they're doing is turning a program that it's meant to be a temporary safety net into a program that it's replacing the role of businesses, given that they are being falling short of cash as they're shut down. So no, it's not really about disincentivizing work. This is an emergency measure through an established mechanism that allows the transfer of cash through to households.
So other critics of the stimulus plan have argued that this could appear to be our early form of socialism, paying people to stay home, giving money to small businesses, giving money to companies, where in the past, obviously we live in a capitalist economy. And if this virus continues to spread, let's say, hopefully not, but let's say it's August and we're not seeing the peak or the apex yet, does the government go back and now infuse the economy with even more money?
Yeah, it might be an exaggeration to call it a drift towards socialism. What they're being called in some outlets is to universal basic income. How much would it resemble it? And yes, in principle, is the same. However, this package that was approved on Friday extends the 6 months in usual length of the program. It varies somewhat by state to further extra 4 months, allowing for the disruption that the economy has been going for. And in addition, the federal government would give $600 extra a week to whichever program is running in each specific state. So whatever weekly pay they have for unemployment insurance, the government is going to top it off by 600. And again, this is just to keep the stream of money flowing rather than an unemployment program in normal times.
Yeah, other critics of the stimulus plan, and one in particular, Alexandra Ocasio-Cortez, argued that it was a corporate bailout, that 80% of the stimulus money is going to corporations and businesses as opposed to going to the people. With this plan, should more money have gone directly to Americans that have been laid off, or as opposed to giving billions of dollars to large hotel travel companies to support them?
Yeah, the shock to the economy has been everywhere, as we said before, in the production and in the consumption side. So the program has helped for both through the household programs that we just discussed, including the transfer of checks, the $1,200 checks for households under $75,000, individuals under $75,000, or joint income of $150,000. In addition to sick leave in previous packages and unemployment insurance extensions. On the firm side, they are protecting small and medium-sized businesses through these loan/grants. But the economy is made up of large businesses as well, and that have been distressed to a great extent, as we know, in the front line for the travel industry, transportation, that need help as well to keep the economy functioning. I have no political leaning in this regard, but there were lessons learned from the 2008 packages that they are attaching more strings to the way that this money going to big corporations that can be public entities is going to be spent and what sort of oversight they're going to be having. As for the amounts, roughly it's 250 billion for households directly through checks, another 250 through unemployment insurance programs, 350 billion for small and medium-sized business, and 500 billion for large enterprises, for the health sector, and for states as well. So that gives you a breakdown of roughly the 2 trillion, that it's quite balanced between households and the production side of the economy.
Yeah, we talked about the over 2.2 trillion. One question I had, as well as people have asked me, is it's obviously a lot of money, but to this country it may not seem like a lot. But where does this money come from? Like, what account, what budget, who pays for this ultimately?
Yes, well, to put it in perspective, it accounts to roughly 10% of GDP, of the gross income of the United States on a given year. And this eventually has to be funded through debt. The way the government works is funding its transfers and purchases through taxes and debt. But given that this was not in any budget, any federal or state budget, the shortfall will have to be coming from debt, issuing new debt. That in time is going to be paid through taxes. But yeah, this will push that upwards. And just a little parenthesis, I know that the discussion focuses mostly in the US and in the area. But in case of the European Union, they are also foregoing some of the limits that they have for debt and deficits in their monetary union to allow countries to borrow more in order to overcome the situation. So the fiscal and monetary reaction globally has been mostly the same.
Well, back on March 5th, we talked about the interest rate cut, which I think it was a half point back when we interviewed you. And you referred to it as your words, a blunt instrument to help the economy by cutting rate. And now since then, the rate now has been cut to zero, right? So what's left? What can the Federal Reserve do if things don't get better? Now that you're at zero, you're not going to go negative zero, right? So what can they do more to help? And I believe Powell came out and said, I'm reading my notes, he came out and said, we have other things that we can do to stabilize the economy now that we're at zero. So what other things can the Fed do?
Yes. As a tool for incentivizing spending, interest rates play some role in a form that takes time to spread into the economy. And at a time when we are not supposed to be going out and spending, that's the nature that for now it's a blunt tool for stimulating long-term spending in investment by firms or household discretionary spending. However, the Federal Reserve learned many lessons in 2008 and jumped into non-conventional instruments. That was the famous quantitative easing, where they started buying US secondary market treasuries beyond the usual 1 month length that are the ones that are used for monetary operations. So they bought across the whole time horizon, the yield curve. Also, the Federal Reserve now is buying corporate debt directly. They are also intervening in money markets directly, providing the funding that is necessary for all these subsectors that are always, these are the pipelines of the economy that are not visible but need to be functioning. Because so what's being a production and spending crisis doesn't become a financial crisis. No? So they are guaranteeing the flow of credit flowing through the economy by directly not only buying secondary market treasuries, but new issues of treasuries, and also secondary debt of corporations and new issues of debt by corporations. So it's a strong way of intervening, even though the traditional interest rate is at this point completely depleted.
Yeah, back on March 5th, when I asked you about will there be a likelihood of this country going into a recession? Again, back then, one case in New Jersey, handful of cases in America. You said, yes, there's a likelihood of if this virus continues to spread, that this country can go into a recession. So are we in a recession right now, in your opinion?
Well, the definition of recession is 6 months of continuous reduction in GDP. So we cannot call it like that technically yet, but that there's a huge drop in output, it's for sure. Once again, given that it's a fast-moving target, any forecast that has come out, it's very uninformative because of the range of forecasts that they're providing, from drop of 10% in GDP by Citibank to 24% by Goldman Sachs. And not only because it's fast moving, but also we don't have the statistical tools, or there are no models that can yield an accurate prediction of this kind of event because simply we haven't had it. In that is my impression of any forecast that you hear out there. They they vary significantly. Just the last one I heard, which was more or less scientifically developed. Well, no, it was scientifically developed. It was by Robert Barr from Harvard University. That said, well, if we were to look at the Spanish flu and how it spread in 1914 to 18, then we can have an assessment that the economy could potentially fall by 6%, the global economy, 6 to 8%. And that is just back of the envelope calculation based on an experience from 100 years ago.
Well, speaking of forecasts, because again, everyone has their own opinion on when the economy will bounce back, what time frame. Former Fed Chairman Ben Bernanke came out a couple of days ago and predicted a very sharp recession in the United States economy, followed by a fairly quick rebound. And his thought is by fourth quarter, assuming we take care of this virus, by Q4 of this year, we'll see a boom in the economy and things would not go back to what they were, but you would see a fairly quick rebound. Do you agree with that?
Yes, I do. I align to his camp. The reason is that the shutdown was very sudden, but those industries that were shut down first are likely to rebound faster because the same way you turn them off, you can turn them on relatively quick. Reopening the restaurants, many places are on temporary layoffs. So hopefully they are not breaking the links with their staff, right? And through the programs that the government is promoting, it's easier to jump back on. So yeah, this is very drastic drop in spending. It would be very sharp, but hopefully the recovery, it's also quick in the sense that all these things that were turned off can be resumed relatively quickly.
So, I mean, as an economist, are you hopeful? You feel that the economy will get better? I mean, thinking of the people those 3.2 million people that lost their jobs, and I suspect every week it's going to grow. That person out there has to pay rent or pay their mortgage or feed their kids. Will things get better? Are you hopeful? Are you an optimist with this situation?
Just in the sense of what I just said, that resuming operations might be relatively quick. On the other hand, not so much because, for instance, the Department of Labor reports that the fraction of the unemployed that are on unemployment insurance in normal times are roughly 30% of the unemployed. So there are 30%, 70% that are not part of this. In another interview that I did last week, the journalist was asking, so who is to take care of the rest, right? So if you fall outside of the safety nets, my answer was just, well, the social networks that I might have, family, friends, and then the work of some charities. But that is the only word of caution that I have, that even though that the unemployment insurance program is running an effective one, at least before it was not broad coverage, even though now they have included in the legislation as a legitimate cause for unemployment insurance, anything related to the coronavirus. So to qualify in the past, there were some criteria to meet, that that the job was lost by no fault of one's own. But now the provisions include coronavirus, so that would make many more people eligible for the program that in the past were not.
Yeah, and of course, and the issue then could be is, from what the doctors are saying, this could cycle back in the fall, assuming we contain it by summer, we flatten the curve and we mitigate it. But with fall, winter coming in, it could cycle back in, and it could have another impact to the economy, which we can't speculate right now because we're so far into this first issue. That's the big mystery of how the medical community, I will hope to be more prepared for it, as well as the economy, that if in case this comes back, which it probably will, hopefully at a small scale. It's like the flu, it's cyclical. So, and plus we'll know more by the fall on these antivirals, if they're effective, and the vaccine possibly next year. there's a lot of factors going into it. So I've heard a lot of discussion about that second cycle and what will happen to the economy.
That is true. And there was another paper coming out recently from UCLA that they said, well, if depending on this curve, how much we're able to flatten it, the middle run effects that you're talking about will be clear if about 2% of the labor force were to fall ill, then the economy would begin to feel quite disrupted. And if more than 10% of the basic infrastructure people, the labor market associated to basic services that keep the economy running, were to fall ill, then the economy once again would be quite disrupted. So the point exactly for the middle run, as we're discussing, is to make it as flat as possible so that we don't reach these thresholds that can have much bigger disruptions in the entire functioning of the economy.
So along with Dr. Portes providing his expert commentary to media, which he's been doing over the past couple of weeks, as well as his spending time with us, he does have a day job. He is a professor of economics at the Feliciano School of Business. And as with other universities across the country, we've moved to online learning, so our students are not on campus. So I'd be interested, Luis, to hear about how that's going with your online learning and distance learning you have with your students. What have you learned? What are some of the positives? What are some of the negatives of doing that?
Oh, yes. No, thanks. In a few minutes, well, half an hour, I have an online class. We started last week. The transition has been seamless because through the course management systems I've been using Canvas Conference, so we connect directly. There are positive surprises. For instance, last week, one student was attending the lecture on her kitchen table, and there the mother was around, and I was asking, so how are your families dealing with this? And so the mother jumped into the conversation. She has an air conditioning and heating business and was telling about the layoffs, how the demand for her services has fallen, but at the same time she has to cater to hospitals and banks that are part of the essential activities of the economy. So that was fun. That was interesting. Everybody got more into the conversation. On the personal side, what I miss from being in the classroom is that they see me like this, but I don't get to see them. So I don't get the nonverbal feedback as how fast or how much time should I spend on certain things or not that you take for granted. But what we're learning, and so far has been good. Has been good. I have no terrible stories about it. So it has been good. We got all the support. I got my headset. I got a writing pad. So we're good.
How are the students adapting to that online learning? Is it the technology?
They are. It's a lot of communication in setting the expectations. From the beginning, I tried to let them know that instead of seeing me in person, they would see me just on their computer, but that would be basically the biggest change, so that there's not a buildup of anxiety. Tweaked the syllabus and exams and all that, the least, to maintain that ongoing commitment that had been built up to spring break on how to deal with the course. And we're meeting at our scheduled class time.
Great. Well, I want to thank you for your time, your knowledge, expertise. I know we'll do another follow-up. Hopefully in a couple of weeks, we have better news to share on the economy, and obviously more better news to share on the virus. Hopefully we start seeing some cases declining. But until then, thank you again. And for those who are listening, this podcast is on the Business Edge, as well as it's on our social media channels. But I encourage you to look back on the interview we did with Luis back on March 5th, just to juxtapose how things have changed in the 3 to 4 weeks and how the economy has changed and how the world has changed. So until then, thank you, Luis. Have a good day.
Feel you too. Thanks, everyone.